following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
In this segment on Thursdays, we are always privileged to be with Anthony Crudele. Just fantastic insights from him on every one of these episodes. And Anthony, thanks for joining us.
Great to be with you today, Mike. We're going to talk about correlations. And really, one of the things that I want to really focus on today is because I think so many people, when they think of correlations, either they fully believe in them, and when they're working, they're great. And when they break down, they don't realize there's actually something to play off of the breakdown of them as well. And I always, when I always think of correlations, they work until they don't, but there's always information there. So even when they break down, there's something to tell you about the market that you're looking at for correlation.
Yeah, another way of thinking of correlations is the idea of intra-market relationships, right? So basically, those concepts are really synonymous in some ways, where one market will move in correlation with another, or one market will move in opposite correlation with another. And of course, many markets are just completely uncorrelated altogether. But the idea of being able to identify that correlation, I think, is very valuable for traders.
100%. I'm going to go over a few right now before we get to the charts. I think that a lot of people look at. Some I agree with, some I disagree with. The first one, which I disagree with, and I see it all the time, and I'm curious what you think about this one, Mike, because I heard you guys talking about Bitcoin in the previous segment. Like Bitcoin and equities, I mean, they're risk. I look at them as risk assets. I have never made a decision to buy NASDAQ or S&P because Bitcoin's going up or down. And it's funny because a lot of people will look at that when you get news over the weekend and say, oh, Bitcoin is up or down big coming in. What is that going to mean for futures? And I have always found that it's so erratic. I have never been able to nail down any sort of situation to where Bitcoin has helped me with NASDAQ. Now, mind you, when risk assets are going up, like right now, equities are in a bull market. I think it's a good time to be in crypto because people have more money, and I understand that. But I've never understood why I would want to sell NASDAQ or S&P if crypto's down, or buy it because crypto's up.
That's a very strained correlation as well. I think that any two markets can look correlated on a short-term basis, but there has to be an underlying fundamental reason why they're correlated. Otherwise, there's no correlation in my mind.
Exactly. And one that people don't talk about a lot, and you and I were talking about this a little bit before, and you're much more familiar with it than I am, is really the soybeans market versus the crude oil market. And it was interesting because when you and I were just thinking about some things we were going to talk about here, that had gotten brought up. And I want you to shed some light on that, because I think that's a very interesting market to talk about, soybeans versus crude, because we got a lot of crude traders out there.
So in my mind, this is a pattern that you see in crude oil and soybeans, and really for a lot of the agricultural products, because they are so sensitive to energy prices. So when you think about all that goes into soybean production, not just the energy that's used to put it into the ground, the energy to take it out of the ground, the energy to transport it, all of these different things come into play. And so certainly if crude oil prices go up, you can see a correlation in some of the agricultural products. Just a warning, though, is that sometimes when these markets, when crude oil is flat or it's consolidating or it's range bound, I think there's a less correlation there. I think you really see the correlation when crude is on the move.
Yeah, I've been seeing a lot of people on social media now talk more about the beans. And so I thought that was an interesting correlation to bring up as well. So if you're a crude oil trader, check out the bean market. It could give you some assistance. And actually, when we get to the charts in a little bit, I'll show people how I like to compare apples to apples, because I think that's also an important aspect of it. Two correlations that I use all the time, and we're going to talk about those today. Obviously, S&P, NASDAQ. And I think that a lot of people get a little bit thrown off with that one because they'll a lot of times look at the NASDAQ as like, oh, the NASDAQ leads the S&P higher or it leads it lower. And in reality, that is true merely because of the volatility aspect of it. NASDAQ moves first. It hits price levels. It's going to be more responsive. S&P price matters much more. There's going to be a lot more absorption in levels, so it's not going to react as quickly. But I want people to think when you're looking at correlations, especially with like the S&P or NASDAQ, you want to compare apples to apples, support to support, resistance to resistance. Is the NASDAQ reacting and the S&P hasn't quite gotten there yet? Find context and nuance in those situations, because just because the NASDAQ pops and the S&P is sitting there does not mean that you want to buy the S&P or vice versa, right? In terms of correlation, it's important when you see all of the indexes and use something as simple as I'll probably show a chart of this just in a moment of like a 5-day moving average or something where they're all hitting it at once. And the first one to respond off of it could be a leader for all of them. Everybody can put that in their mind and understand how that works. But just because the NASDAQ's moving higher or lower on an intraday basis, that does not mean that that is going to drive the other index in any direction.
Totally agree with that. And you brought up a great point in that the technicals across those four markets often look very similar, right?
Yes.
So moving averages and certain support and resistance level, different indicators, those markets tend to do the same things. So when you see one of those markets not doing the same thing, that's one that you have to kind of avoid at that time, because you're looking for those correlations. You're looking for the first one to go. Sometimes one of those, sometimes the Russell, sometimes the Dow is doing something completely different. And that's a market that you just need to set aside for that day.
Yeah, exactly. And I've talked about this a lot in the show. When you look at like an S&P versus the NASDAQ, and if the NASDAQ is rallying more than the S&P, to me, you always want to be long the strong or short the weak, depending on the primary trend. Primary trend is up right now. I'm always looking at leadership to who's the strongest on the day. And if it's the NASDAQ or if it's the Russell or if it's the S&P or the Dow, that's the market I'm more inclined to be long. I don't want to buy the weaker market and a tape that's going all together. I always want to buy the stronger market because it's reaching higher targets. And so that's also something to think about when you look at correlations, is that if you look at a correlation between S&P and NASDAQ or Dow and S&P or any one of them, the one that's actually leading in that direction, and when you're looking at that correlation, that's the one you are more inclined to want to be in, because that one is getting the greater response and potentially has a greater potential. And so I think that's also something that people have to keep in mind.
You're talking about measuring that. What do you typically look at for that? Are you looking at the percent change on the day? Is that primarily what you're looking at to pick that leader?
Yeah, and there's that. And also, I think another simple way is maybe let's go to the charts now and let's take a look at a couple of things. One of the things that I'll look at on a regular basis, everyone knows I like to look at a 3-minute chart, and I like to look at where we are relative to like a VWAP, right? Here's VWAP, regular trading hours session only. And I've got cumulative delta here as well. And here is just the NASDAQ. So what I will look for is, where is the NASDAQ relative to its 1, 2, and 3 standard deviation bands? I like this as a very good metric for an intraday short-term trader, because if the NASDAQ is consistently staying above a 1 standard deviation or a 2 or getting near a 3, and it's staying above VWAP or vice versa, it's below it, that market will typically stay the strongest throughout the day. Let's take a look at an ES here, just see where that is on a relative basis today. And when you look at that, it'll take a second to pull up. So you can see here, the S&P is now weaker than the NASDAQ on a relative basis for today, if you're basing it upon this metric. The reason why I like regular trading hours, 3-minute chart, just opening range order flow VWAP, is because it shows me who's winning the price battles. Today, the NASDAQ is winning the price battles, probably because NVIDIA, I can't see. It's probably up again. Hopefully, I've got it in my portfolio, so I hope it keeps going up. But ultimately, when I look at that from that metric, a lot of people will say, hey, NASDAQ's up at 1 standard deviation or 2. I want to try and buy S&P. Well, why? And that's the correlation mistake I think they make. What you want to look for is the S&P and NASDAQ, is because they are correlated. I want to buy the weakness in the NASDAQ because they're the stronger market, right? And so if I'm looking at a short-term time frame, this is just one example of something I would look at, but you want to compare apples to apples, right? Don't say, oh, the S&P held my support that you have your level in, and the NASDAQ hasn't gotten there, and it's not derived from the same reasoning, the same indication. Then all of a sudden you're just trading two separate markets, and you're basically trying to find a reason to be in or not in one of these markets. Look at the markets that are for correlation on the same basis, because otherwise you're just really curve fitting that correlation. You're trying to fit it into your reasoning. And I look at this as a simple way to say, hey, S&P is a slight bit weaker than NASDAQ today. Let's go back to NASDAQ. I want to buy the weakness in the NASDAQ, because even though S&P might it really looks sideways. It's a sideways day. Look at how the NASDAQ's already getting close to 2 standard deviation. Number one, you wouldn't want to sell NASDAQ to come back to VWAP, or you wouldn't want to buy S&P to come up to 1 standard deviation. What you want is you want to buy weakness in the stronger of the correlation or the weaker.
The thing to think about is the dynamic of what's happening with that VWAP and those standard deviations. If that market moves higher, that VWAP is going to curve higher. The standard deviation is going to curve higher, and you're going to get that follow through in that direction.
Bingo. And when I say or the weaker, I want to make it clear. If I'm looking to sell in a bear market or in a weak market, I want to sell the weakest, and in the bull market, I want to buy the strongest. And it goes back to exactly what Mike had just said, because the potential is there greater. If you look at the S&P, we went back to it, you've got sideways standard deviation moves. Most likely S&P is a two-way tape. I talked about that in my free note and everything this morning in the Discord. Market's really in digestion phase right now. NASDAQ's still looking to kind of run just because of the internal stocks. I mean, the NVIDIA. I mean, I think it's hard to see any reason to be short NASDAQ when NVIDIA is whatever it is. I think it's like 6.5% of the NASDAQ now. I don't know. I'm not exactly sure of those numbers, but I know it's an increasing number of what it is. And I know it's a big part of the S&P too, but the S&P's got that offset. Mike, I want to move on to, I think this year, I actually heard you and Tom talking about RTY. And this is the correlation at the beginning of the year that was great for me. Probably some of the best trades I had this year were between RTY and ZN, intraday trades. And it was simply because of correlation. And now that correlation is broken down. And I've understood it, and I've not taken trades in it. And I want to go, and this is where I think it goes back to what you said. There has to be a real reason for a correlation. We talked about that, how there really isn't between Bitcoin and NASDAQ and S&P. Some might argue that, but I just don't feel that way. But when you look at ZN versus RTY, why does this matter? ZN is the 10-year interest rates. When you're looking at small caps are more sensitive to an interest rate, a higher interest rate environment than the big caps. They've got tons of money. They don't need to borrow. They don't need to borrow at a higher percentage rate. If anything, they're the ones lending money. So when you look at it from that perspective, it doesn't matter if interest rates go higher for an NVIDIA or an Apple. It matters to the small caps because they have to borrow money to grow their businesses. So therefore, you have a market that is really driven by what the Fed is going to do. We all know Fed's coming up in a week or so. We all know that as interest rates go lower, that the market's looking for a potential rally out of that, but yet higher for longer. I heard you guys mention this. Well, why does that not seem to impact NASDAQ and S&P, but it impacts Russell? Exactly for those reasons. So when you look at the indexes, the 10-year is going to be a great leader for understanding why the Russell is having strength or weakness. I want to pull up a daily chart. We talked about apples to apples. Here we are with a daily chart. I have my Bollinger Bands, 20 period, 3 standard deviation. I have my Fibonacci retracement, which is 100, 70, 50, 30, and 0%. And it breaks down for me where the recent peaks are of the Bollinger Bands, and the 50% is my neutral area. Above it, I lean more bullish. Below it, I lean more bearish. And you can see back down here, this was my 30% where support came in, and 70% is resistance. So when everyone looks at that, this right now, and this, I'm just taking this out a little further in terms of a correlation, because correlations like this, when you're looking at interest rates versus an index, intraday, it's tough because there's going to be days where the 10-year will have a move, has no impact on the Russell. And there'll be days that it moves and it has a significant impact on it. A couple things matter. One is the velocity of the move and the breakdown of a high or a low that might have an immediate impact on an index. So anytime you're looking at something on a macro perspective, like an interest rate and how it impacts an index, when you're inside a range and you have a sharp move in the 10-year, the people that are managing Russell, they might be like, okay, it's moving a lot right now, but is it really changing anything? No. If it's not, then they're not going to be in a rush to change positioning in the Russell. But if it's breaking out or it's having a significant move where it's changing the potential trend of that market, then you have people that are going to be quick-handed in that index. So I think that's the first thing that I kind of want to dissect when you look at it. Goes back to what you had said, Mike. Make sure that there's real correlation there first, then you start figuring out how to execute.
So in this case, I think this is a fantastic example of correlation in that these markets tend to move pretty well together, and there's a foundation for it. Like you said, it's these companies are interest rate sensitive. What's interesting about this particular pair is that there is another element in my mind, which is expectation. So expectation based on what the FOMC is going to do, where they think interest rates are going to be at the end of the year. I think a lot of that also plays into reinforcing that correlation. So you were talking about intraday trading. This is a great way to create a bias for yourself during that intraday trading, right? So you don't necessarily trade the correlation, as you said, but you can build a really good bias for the Russell based on what those 10 years are doing.
100%. Think about this, everybody. Look at what the Russell has done relative to the S&P and NASDAQ and Dow. It's not done anything. It's weak. Why is it weak? Because we went from 6 to 7 potential cuts going back to November when the Russell rallied 5%. And since then, it's really done nothing. Why? Because going back to what Mike said, the speculation on what interest rates are going to do has now come down to potentially one cut or even none, or who knows, maybe a hike. And what I find difficult about the Russell right now is that from a day trader perspective is that you now have this scenario where it's almost feeling like a soft landing could be more and more in play. It keeps coming back. There's ebbs and flows of this, right? And, you've had cooling of the jobs data, inflation, it's not coming down the way people want, but it's not also ripping back up. And so you have this scenario where maybe the Fed just continues to do nothing, or we're set up for a potential soft landing. And ultimately, how can people manage that within the Russell? And the Russell is currently not responding to what's happening in 10-year. 10-year is actually making a higher high than it has from June to May, which is significant in my opinion. And I want to pull up the Russell chart just so we can give people an idea of what it looks like. And if you go back and look at the Russell compared to, you could just saw what the ZN looked like. You can see that it looks very similar, very sideways. Russell's still barely holding above the 50% line, but when you look at it on a relative basis to May, it's not made a higher high. So at the beginning of the show, I talked about this. Correlations work till they don't. And then all of a sudden you have a breakdown, which is also information. If you go back and look at majority of this year, when this move was lower in Russell, same time you move lower in ZN. When the move came up in Russell, you saw a move up in ZN. Now you have a breakdown in this exact moment right now, this moment where the Russell is now not taking out the May high. And so what that is actually telling you is that the Russell is there's people that are long anticipating that that's what should happen. And what happens is you're seeing squeezes and squeezes every day. Russell tries to rip and it just breaks right down. And the reason for that is because it's not following through on that correlation. So when you what happens is you get a lot of longs trapped, and you get longs trapped because everyone is trying to chase what was working and now it's not. And so what happens is the Russell becomes almost a dead index. You also have Russell Recon, which is at the end of this month, which also I think is a factor. But ultimately, you have a breakdown in correlation now. Why is it information and how do you use that? If I'm a day trader right now, why am I trying to buy Russell? I'm not. What I want to look for is squeezes on rallies. Why? Well, because the breakdown is happening. You've been people that have been long Russell, sitting there long Russell. You can go back and look at so many people that have said, looking for a big move in Russell this year, a lot of funds, right? Because of the anticipation of lower rates. Everyone's stuck holding the bag right now. And it gets really interesting here because if the Russell doesn't follow through in a big way, they're all stuck long. Nothing worse than being in a position where the correlation that you've been looking for starts to work on one side, but the other side doesn't. That is so dangerous for positioning because now the Russell is, in my opinion, let's go back to look at today. Look at today. Perfect example. We see nothing but positive delta in the Russell. And what happens? It can't rally. Isn't that interesting? When you look at the Russell, it can't rally. And the reason why it can't rally, okay, is because the longs are trapped. So you're not getting this, let me actually, I want to pull my pointer out here. I forget I have this pointer here. So let's go back here and look at, let's this right here. Look at this delta. All bullish today on the lows, right? And I pulled up it on the dome. Everyone keeps trying to buy into the RTY thinking, well, look at 10 years going up, 10 years staying bid. Why can't the Russell? And you get trapped longs. And what does it keep making? It keeps making trap highs. So you get up here, you see this volume build up here, all these buyers on the delta, bang, it comes right off of it, right? Cannot hold it. This morning again on the open, I saw it. They tried to buy into the rally, trying to go and fill the gap, can't do it, bang, lower. Right here, buyers come in this area, right here, trying to establish a low. Goes up, bang, lower. Trying to buy here, bang, lower. And the reason is because now the funds, the big guys, what are they doing? They're saying, look it, we see everyone trying to play catch up to this move. We've been long it. We're long Russell. We think it should be going up because rates are going down, and it's not. So now they use the volume that comes into the buy side to sell to them. And that is because it's a breakdown of correlation. And there's no two ways around this that unless the Russell rips higher and it just does an absolute steamroll and starts taking out a new high, this is most likely the market you want to be selling rallies in, and just like the opposite of what you want to be doing in NASDAQ. And that divergence and that correlation can go on for who knows how long. It's such a good question because you would think that there is a systematic way of understanding that. And what makes that difficult, where it starts to come back is a day or two of the correlation back to working. And ultimately, you see a situation where, okay, it might be reverting back. Then it's a time thing of, do we start to see it on a regular basis? Because one of the most difficult things about correlations is that, in my experience, I have found that there is, it really can be, even though something like the 10-year and the Russell worked for a good period of time, it could be really hot and cold. And what happens is that you, especially right now, you've also got rollover. I mean, so you have to put things into perspective. I go back to the context of the situation. You got Russell Recon, you got rollover. Russell Recon is the annual rebalancing. If people don't understand what that is, it happens at the end of the month. And so what happens is that everything gets changed within the Russell. It's done very differently than the NASDAQ and the S&P. And so it's more automated than that. It actually is automated. And so when you have that perspective, you have stocks that are moving within it. So you have a lot of rebalancing. You also have rollover, which right now we move from June to SEP in 10-year. and Russell is still in June. And so it hasn't moved a step yet. Once we get through some of these points of where you're going to have random flows anyway, because that's the thing, Mike, you and I both know, because we've been experienced, a lot of people out there aren't, is that you have these other things that come into play, like a rollover, like a Russell rebalancing, that ultimately could play a role. But let's just say on a perfect level playing field, we're past some of these things, and we get back to your question as to how I recognize it. To me, it's a day of all of a sudden it's working again, and then I watch it for the next few sessions, and is it finding its way back in rhythm? Because that's the one thing about correlations. They're built on rhythm. So machines out there will see that, and there will be a time where the rhythm is really clean. And when they start to break down, I go back to it, that's back to evidence. Either don't use it, or you use the opposite as your advantage. I actually think moves in 10-year higher right now are working in the opposite way because of what I see here. I continue to see positive delta with lower moves in Russell. And so and when I start to see that change back to that correlation with ZN, and it lasts beyond a couple of days, then I say, okay, maybe we're back.
There's a lot of balls in the air when you're talking about interest rates and the stock markets. You know, what is the expectation for the economy, for inflation? All of these things in the Russell are more predominant than in any of the other markets because they are so sensitive to those interest rates. So it's an interesting dynamic.
Yeah, and I know as we're running out of time here today, people want to understand this, is that as a trader, it's important to understand the macro situation. I don't believe you need to be a macro expert. I don't think you need to be someone who comes in and understands every data point, who understands all of these other things out there that I think can overwhelm you more than anything. I think the important thing is when you're trading indexes, understand that your short-term chart, over time, you're going to find edge with the technicals. But where you really develop an edge, where you really develop a career as a trader, is to understand market environments and understand when a strategy that you're using and why the market is more conducive to that strategy and that time period. And that comes down to a more of a macro perspective. Early on in my career, I was only technical and I did very well. But when I started to understand macro themes, not that I was ever a macro expert and don't claim to be one, but some of my best years were 07, 08, understanding COVID, understanding a lot of different times right now with interest rates. Like I said, some of my best trades this year have been in the Russell because of what's happening with interest rates. I'm able to maximize opportunities. And if anything, I keep myself out of some bad day trades versus like a day like today. Why would I try and chase Russell higher? If the 10-year continues to go up and Russell can't rally, why am I going to fight that? The old me would just be like, oh, that correlation worked. I want to use it. I want to fight it. Now you understand the situation and you understand that maybe this correlation's not working as much. And the same thing goes for what we talked about with NASDAQ versus an S&P. If the NASDAQ and S&P are both going higher, you always want, and you look for correlation in leadership, always buy the strong and a strong tape. And if you're looking to get short, you get short the one that's weaker, the weak tape. Just look at today. Look at S&P, look at Russell versus NASDAQ. If you pull them all up, you want to buy the NASDAQ. You don't want to sell the NASDAQ to catch the S&P or buy the Russell to catch the S&P. You want to buy the strong or sell the weak, depending on the tape. Hopefully this helped you understand correlations.
That's really fantastic information. Anthony, if somebody wants to find you, how can they find you?
On X at Anthony Crudele and anthonycrudele.com.
Next Thursday. So thanks so much for being with me, Anthony. Thanks everybody for being with us. Any last words?
No, always a pleasure to be with you, Mike. And I hope Jimmy has a great vacation. And Tom, I miss you, buddy.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.